We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Goodburn, founding partner of WaveTrack International. Thanks for joining me today, Peter.
Great, Tom. Great to meet you. Thanks very much for inviting me.
It's great to speak with you, and we have a lot of interesting charts to go through today. And I'm really looking forward to this discussion and, some of these explanations after going through, the reams of data that you're able to put out here. It's really interesting. So, your experience in analyzing markets goes back to the late 70s. And in one of your first annual diaries of 1978, you remarked on how the interaction and relationship of fundamental news and price movements often contradicted themselves. So how did you make this connection? And what was the process that seemed more reliable to you than taking only these fundamentals into account?
Yes, well, that's a good question. I mean, it's a long journey to actually arrive somewhere where you think that you can decide exactly how price action interacts with fundamental news flows. I mean, I think everybody knows that with news flows being what they have, they influence price. And we can see, clear evidence of that. But sometimes it doesn't always occur like this. And my experience began in the late 70s when I was working for Billiton, which is one of the mining group companies. And we were actually the largest London Metal Exchange broker at the time. And in the trading room, my job in those early days was to take all the information off the ticker tape. Literally, there was, a paper ticker tape, and disseminate the news. Basically, look through the whole evening's news flows, and put it on the traders' desks for them to read, give them an overview. And of course, when you're actually immersing yourself in information flows like that, and a lot of it, and then suddenly you're looking at the way that the price action works through the day, with thousands of trades going through, manual telephone trades, that is, and doing them yourself, you realize that there's a large part of that is a disconnect. And the news flow doesn't actually work out the way you expect. And that caught my imagination, because then I was starting to plot where the price actions were. And I was keeping a diary in 1978 of exactly those types of events. And so my conclusions were quite concise about the fact that, a lot of the time, the dealers would lose money purely because they're trading with the news flow, and yet their back books are basically showing a negative, maybe. And so that got my curiosity. It wasn't quite some years later until something like the mid 80s that I came across the Elliott Wave principle. There was a radio show actually in London from London Broadcasting Corporation, LBC News, and that was a guy which was a Canadian guy, and he was actually talking about Elliott Waves, and I got to know him a little bit through that, and then started up experimenting with this process myself, and eventually it got to the point where I realized that you could actually predict price levels with a high level of accuracy using this methodology. I thought, wow, that is incredible. But what about the news flow still? Is that still relevant at all? For a while, I was combining both and getting mixed results. And eventually, I realized that you get the best results if you just ignore the news flow and just look at the process itself. Mm-hmm. And of course, the Elliott Wave model actually falls within the realms of technical analysis. So in those early days, I started joining the London's Society of Technical Analysts in the 80s, and then you start rubbing shoulders with a few other people, maybe familiar, and you begin to build up a process. But it was somehow that process was jiving with me because it basically annulled the idea that not all price action is relative to the outcome of the news flow.
Mm-hmm. Yeah, and it's interesting to, like we said, kind of turn this way of predicting the future, as we were talking about before we hit record here, by looking at the charts and how the charts resolve versus how the news flow narrative is kind of presenting itself. So you were kind of giving me an example of how we could kind of look at the Russia-Ukraine situation, and by looking at the charts, realize that there's very more likely a diplomatic solution that's going to be reached, right?
Well, that is certainly my assumption, and that's certainly what I'm telling my clients at the moment. Maybe if I share my screen a sec, we can maybe have a look at a Russia index, and just let's pull something up here. I've actually got the S&P 500 on here, so I'm just going to switch to having a look at Russia. But basically, one of the key proponents of Russia's index actually looks bullish to me, and the reason why is that if we take a look at this overall decline from October's high at 52.80. Now this is an iShares MSCI Russia index. It's an ETF, so everybody can trade this, and the symbol code is ERUS. Anyway, the decline from October 52.80 down to January's low at 34.03 is what we describe in Elliott Wave terms as an archetypal corrective process. It's actually, we give it a name, we call it a zigzag. It's composed of 3 price swings, down, up, and down. But that process we can actually measure using the Fibonacci sequence. And if I just go to one of my models in that, I've got an example here. Now this is the 3 price swing events down. I'm just going to change this to red so we can actually see it a bit better. Overall, the 3 price swings I'm talking about is down, corrective rally, and down again. And if we basically take the measurement of the first sequence downwards and use the golden ratio, which is 61.8. For those of you maybe more familiar with Fibonacci ratios, the golden ratio is like the ratio to use in terms of price measurement. And if we extend that initial downswing by 61.8, if I double click, the software is going to project a 61.8 line. That should tell us where it stops. So I'm going to double click now. And there you see it projecting where the next decline should stop. So I mean, if you were basically only looking at that point of that decline and you applied this ratio before that event occurred, you would be projecting a downside target here around 34, and the actual low was 34.03. So this gives a quantifiable proof that we've seen this particular pattern, this zigzag end here. And furthermore, the index has rallied sharply higher after that. So it's almost affirming or validating that the trend is now upwards, not downwards anymore. And of course, when you look at the news flow from Russia, and certainly from the media outlets that we're seeing, everybody seems to think that it's inevitable that Russia will start to invade Ukraine and set off a whole chain of events that could last for months. But this chart itself, in its own right, suggests that wouldn't be the case. That actually we should see a diplomatic solution to that.
So, Peter, what kind of timeframes can we apply this Elliott Wave model to? Do they work, very long term, very short term? Are they particularly good at one time frame versus another? Well,
in general terms, it's a fractal process. So the application of this is applied to all time frames. So we can go back over very long periods. So back to the Great Depression lows of 1932, where a lot of prices were decimated at the time. So commodities and stock markets were hitting actually centennial lows at that point. So that's a good frame of reference. And the Elliott Wave model works fine from that point. Or we can look at intraday activity. Now, if you're working with the Elliott model in intraday activity, you've got to ensure that there's enough volume going through on a contract to actually evolve the waves, because it's a bit like if you're trying to make a cake on ingredients that are basically watered down, the whole cake's not going to rise when you bake it. So you've got to have the ingredients there to ensure that you get success. And I've found that sometimes a contract is maybe a peripheral contract has too few trades going through. Now, if it's like that, it's not going to be good for intraday trading. You need something with some volume. But that same contract that's not frequently traded intraday might be fine if you look at it on a daily chart and want to plot this theory, overlay it. Maybe looking at a daily chart like this. Let's look at this is a daily chart of the RTS index, and you can quite comfortably get some insights to how the price development will occur on that, even though there's not a huge amount of trading intraday. So it's just dependent on basically the amount of volume that's being punched through, whether you're going to trade intraday or not. But it does apply to every time frame. And one of the things which is really quite remarkable is one of our forecasts. I can pull this up. Actually, this is completely on the spontaneous. We're doing this now, but I'm just going to pull up a forecast that we did for the financial crisis. I think you might find this quite interesting, Tom, because in terms of price prediction, because the financial crisis has come and gone now, it's history. But at the time, it was an extraordinary event. And of course, price declines were really significant. And when we went back to our forecast in 2004, so that was 3 years before the financial crisis even began, we didn't even know what the fundamental situation would be. We didn't know anything about subprime, the whole fiasco with property and the collapse of that would be a trigger point. We had no idea. But I'm just going to pull up an old chart. I hope I've got one here. I think I have. This one. Let me just show you this and everybody listening in. This is the Dow Jones chart that we actually updated in 2004. We didn't have a name for it at the time other than the Elliott pattern that it's projecting. It's called an expanding flat pattern for anybody clued up on Elliott Wave. It's a corrective pattern within a prevailing uptrend. But the actual origin point began here, which is the .com peak. This is the Dow Jones at 11,750. And we had the Twin Towers episode, and then this collapse into October 2002 at 71.97. And then we started getting a big revival to the upside, and we said, okay, we actually understand what this pattern is doing within the context of the preceding uptrend from the late 80s and early 90s, right the way through to the .com peak. And we said, this is likely to evolve as this pattern, an expanding flat, but it means that there would be a correction down like this, and then an upswing to about 14,169. And that's purely derived from using Fibonacci ratios. And then there's going to be this enormous collapse down to 64.11, like this. I'm just trying to see if I've got an outcome chart. Yeah. And the next chart actually shows the outcome. Now, you've got to remember that this is, first of all, it's got to decline like this to around 9,300 and then go up to 14,000 and then collapse to 6,000. And this is the outcome of that. Here's the correction down to 9,000 something. Here's the upswing to 14,000, and here's the collapse to 6,000. So it's exactly unfolded into that model, and that's remarkable because that's an advance or a forecast 3 years in advance. And if you ask any mathematician what the probability of predicting that, he will say it's practically zero. You shouldn't be able to predict things like that. And yet here we were 3 years in advance predicting the Dow at 14,169. The actual high was 14,198. And the actual low was 64.11. We got to 64.70. So using those types of methodologies, it's quite humbling in a way, very humbling when you can look at that, because you seem to think, well, okay, how can that possibly work? What are the underlying issues there? And when I spoke to a mathematician about this, he sort of said, well, for that to happen, it's not a random event. That means that there's an underlying form or concept of methodology. And of course, the Elliott model is exactly that. So when you get to that sort of point and you look at that particular example, you realize that the only thing that's preventing us from taking advantage of that is mentally accepting it.
Right.
And of course, I can show a forecast, many like this that have occurred over time, but if you're unwilling to accept the possibility that that is possible, then you can't ever take advantage of it. Mm-hmm. And even today, one of the struggles that we have as a company with institutional clients is if we show a projection as extraordinary like this to our clients, sometimes it takes a while to sink in, because you've got to conceptually, the mind has a lot of barriers. We have a lot of preconditioning in our concept of how we believe markets unfold, how our interaction unfolds, how the news flow works. Mm-hmm. And if you can't accept something like this and let the barriers down to your preconditioning, you can never take advantage of it. So that's a very important mental attitude as well. Absolutely. It really kind of goes against how we would typically think of things progressing. But, to your earlier point, the ability to kind of see into the future and predict events by looking at a chart is quite an interesting concept that, as you say, it really goes against, our conditioning of how things progress, right? Yeah. I mean, and for yourself, when, if you're trading, this concept of trading is really about how we perceive things. And this really does also allow traders to really understand what their own conditioning is like, because we do have that. I mean, even when I first started in this business, even though I was questioning things, you build up a certain layer of conditioning, especially over the news flows. And of course, we do have to discuss the news flows. I mean, we can't not discuss them, because, these are the topical things. If we were basically robots, we would just apply an algorithm to the Elliott model and let it work for us. And we would sit back in sort of deck chairs with pina coladas and a sunshade and let it do it for us, But there is work involved too. I mean, I have to say that even though we can be mentally familiar with this model, we haven't yet been able to devise a piece of software that can do this for us. I've over the years tested a lot of different software, Elliott Wave software, and it doesn't really work. I think I've identified the problem with it, but this will be something for me to develop maybe later. But at the same time, it's a very hands-on process, as is all trading. Mm-hmm. And when you're trading yourself, of course, you're wondering as well about the different risks involved, and also the different mental attitudes that have to be applied. I mean, we've all been there. We've all had a losing trade. And how much pressure is there when it goes against you? How much is there? You can cut and run with very small stops. That's how some people circumnavigate the pain of the threshold pain that they're going through in the mental level. Mm-hmm. But of course, that itself is not a solution to the problem, because a lot of the time, if your entry level isn't precise, you're cutting out at the first whim of a small P&L against you, only to find that the market's changing direction and going the way that you originally planned, and then you're frozen out because you're mentally unable to accept that you have to get back in again. Mm-hmm. I mean, these are basically attributes of being a trader. You have to circumnavigate those, and so these things are very much in play. So even if you have an Elliott Wave model like this, it doesn't guarantee that you're going to be successful. You've got to apply it, and you've got to be very stoic. You've got to actually understand it and believe in the process. Right, and obviously, I think that comes with time as you build confidence in that model, right? Yeah, it does. I mean, of course, I'm also let down various times through a year as well, because the model looks absolutely perfect, and yet somehow it breaks down, and you think, well, that should never have happened. Mm-hmm. I don't see even at the stretch of building maybe an alternate scenario and twiddling around and tweaking maybe a couple of the waves in order to fit the process. It still doesn't fit. It doesn't seem to make sense. Fortunately, they're few and far between. Mm-hmm. They might happen a few times in a year, but at the same time, it does happen. So, you've got to apply very strict stops and things like that if you're applying Elliott Wave model to your trading. Mm-hmm. But other than that, no, this is, it's a very, very valuable model to have. even if you're short-term trading, you can apply the same rule-based system to it and get great results.
So, Peter, when we think about a commodities super cycle, how do you define it, and what time period does it represent to you? I know you start it a lot sooner than most analysts talk about. So, why is that?
Well, I think that if we're going to understand where future price development occurs, we've got to go back as far as we can in the past. Mm-hmm. And my conceptualization of a commodity supercycle really begins back in 1932, the Great Depression lows, because I've got data on silver, for example, that goes back to 1650, the year 1650, not the price. And I've got bond markets going back, I've got maybe the dollar going back to 1660. I've got very long-term data that I use. It's very important if we're going to understand the future development, to go back to the past, because that's really what tells us what's going to happen. Mm-hmm. And whenever we do go back into the past and look at key commodities like maybe gold, which is on the screen at the moment, or we look at crude oil or some other commodities, there's one distinct commonality which they all share, and that is that they shared a major low in 1932 at the Great Depression lows. And so really, when we start plotting the Elliott model, which is a 5-wave construct of trend, this projection of 5 price swings, we can see that model being replicated in so many different commodities, including gold and, say, crude oil. And they have both, from that low, historical low in 1932, hit major lows, even if we go back 100 years before. So that's a good point to start. And we can see the 5-wave model here. This is gold from $17. And we can see a 5-wave construct, which is part of the Elliott model in terms of defining where a trend develops. Any trend, whether it's over such a long-term period as this, or something intraday, it's all a 5-wave construct. Once that 5-wave construct is finished, you get a compensatory 3-wave correction in the opposite direction, which is basically what this is, like this, coming down. And it would basically, the price action in its corrective construct normally returns back to what we call wave 4 preceding degree. This is the 4th wave in gold. And normally gold in its corrective process would fall back to this sort of price area. And that's a very valuable piece of information, because we see that recurring every single day in intraday data. But basically the commodity supercycle, I believe, began from 1932 because of this 5-wave construct. And in gold, it's still incomplete. We've got a bit more to do yet. The 5th wave, which began from 1999, hasn't reached its upside target yet, which we've got as a maximum about 2,800. Mm-hmm. And if we want to measure these waves, we've got to use a Fibonacci sequence. So what I'm doing now is I'm going to measure the 5th wave, where the price level should attract to. And in order to do that, I'm going to measure the origin of the 1st wave, so the beginning of this 5-wave sequence from 1932 up to the 1980 high, when gold was 850, like this. And I'm taking that 61.8 measurement, and I'm just going to snap it onto the 4th wave low here, like that. And that will take us up to this price target of about, 24.55, 28.80. So we have a very defined movement up there, and that's where our long-term price is. Now, once we get there, the commodity supercycle will be over for gold. But the interesting thing about it is that the commodity supercycle for things like crude oil or maybe copper prices has already finished. It already finished at the pre-financial crisis peak back in 2007, 2008. Mm-hmm. So if we take a look at crude oil, we get a very distinct different picture. Crude oil, where it finished this commodity supercycle in 2007, 2008, has already begun its balancing point, its corrective process. So any action defined by 5 waves has to be followed by a reaction, 3 waves down. And that 3-wave decline in crude oil actually occurred during the pandemic. when in March 2020, crude oil collapsed down to $6.50. Let's take a look at that now. And here we can see the 1932 low for crude oil. Here's the generic 5-wave structure again. This is the supercycle uptrend. But it finished, the 5th wave finished here, just ahead of the financial collapse, the financial crisis. So actually, the movement down to 650 is part of its regression phase, or its balancing corrective phase. And there should be an approximate relationship in terms of time. Well, if this supercycle uptrend for crude oil finished in 2007, so we've got pretty much a 75-year rise, then we should see maybe 2 or 3 decades of price activity in the balancing phase. Now, we've so far seen from 2007 down to that 20. So we've got basically a 13-year decline. But I think that's only part of what's going on in crude oil. I think in the next decade, we're going to just see price rhythm into what we call a triangle pattern. These are the boundary lines of the triangle. Mm-hmm. And the 650 low represents the price extreme of that pattern. And we're just going to oscillate in between. So in the next 6 to 8 months, we're looking at a very sharp drop for oil. And then after that's finished, we're looking at another rally. But this time it's going to go to new record highs. And this new record high process in crude oil is also being repeated in things like copper prices or the base metals. And of course, copper, as you know, is a fundamental core commodity for the world. Copper goes into many different things and products that we use day to day. And copper is also going to see a record high. Now, that's the misconception. Because prices go to record highs, people normally assume that that's a new supercycle development. But it's not. It's actually part of this decennial or this multi-decennial corrective regression phase. And sometimes a regression phase has a movement, a price movement that actually will make a new record high, like we're displaying here. But it's not actually a new supercycle. That ended way back here in 2007, 2008. So that's the distinction I make. And it's a very interesting distinction, because if you make that distinction and you know relative terms, there are finite upside potential for these commodities. Now, this movement up, copper actually started its movement up far earlier than oil did in 2020. Copper actually started its counter regression phase and its post-financial crisis uptrend much earlier, basically at the bottom of the financial crisis lows. I'm just going to pull up copper. Maybe I'll show you this because that's a very big distinction. Because if we're going to then plot commodity prices, oil and copper going to new record highs, but they're not part of a new commodity supercycle. Here's copper over a very long-term time frame as well, from, again, 1932. This is the same format of 5 waves. But this one is not a triangle pattern. It's what we call a different corrective pattern, an expanding flat, but it has the same idea, that it trades into a new record high. Here's the previous record. The orthodox end of the commodity supercycle. And this is just part of a correction. It's going to make new record highs. And if we know that, we have a finite measurement from which it can make those new record highs. So that's really important. And from that, we can distinguish then that this will eventually run out of steam. I think probably around 2024, something in that time frame. And then copper will collapse afterwards, as well as oil will. Mm-hmm. So that's a really important part of this equation, because it gives you a finite amount of upside potential. You actually know well ahead of time what you're looking for.
So, Peter, how does the dollar play into all of the commodity prices? I know going through some of your stuff, you were saying that the dollar downtrend has, a part to play here as well. So, could you explain that to us?
Yes, I mean, the dollar is a very topical issue, because people assume that the dollar as a reserve currency is always trending up. Again, I mean, if you asked maybe 10 analysts or 10 traders who are familiar with the dollar, whether the dollar's in an uptrend or downtrend, I wonder what answers you'll get. I think invariably they'll probably say an uptrend. But again, this is perception. If we take a look at a very long-term dollar index and look back, well, our data goes back to 1660, so we can look here. And this is quite an amazing event situation because we're going back to the origins of the dollar when it was coming from the Spanish dollar and fixed to the Spanish dollar. And then we go up to these levels and we get a price collapse during the American Civil War. So during that time, we get a major low at basically 22. Now, what's remarkable, again, from that history of 1863, is that we start to develop higher into this archetype pattern that we see so often in Elliott Wave, a 5-wave process. Wave 1, regression 2, 3, regression 4, and then the 5th wave. And so the actual peak of the dollar as a historical currency was basically 1985. And this is a quarterly closing chart, which was just below 150. On an intraday basis, we were above 160, 164. But this is quite remarkable. And again, we can actually measure the Elliott model on this. If we take a 61.8 correlation ratio of 1 to 3 for wave 5, you can see this is the projection where it should have finished. Mm-hmm. Pretty accurate. And from that period on, we're in a regression phase, except that this, unlike oil, where it collapsed down to 650 in March 2020, this one is still trying to complete the same or similar pattern down to 49.35, which is a bit horrific because that means that the dollar's going to basically drop by about 45% over the next few years, mm-hmm. over the next several years. And that has a very big impact in some of the commodities we just looked at because, that eventually might fuel the next phase of crude oil and copper going to new record highs. Mm-hmm. I don't think it's ready to do that just yet. I think there's other demographics in the background which will temporarily allow the dollar to fall. And at the same time, we're going to see that's really linked to inflation pressures and the inflation expectations that everybody's had for the last several months. Mm-hmm. So I think the dollar eventually will run out of steam in a month's time to the upside, and then we'll start to see a new dollar phase of declines. But I think that could also mean a phase of risk off for assets like risk assets like copper and the stock market, because I think inflation pressures, which are basically right with us at the moment. The latest CPI in the US was 7.5%. I mean, that's the headline number, way above the baseline of interest rates. Mm-hmm. That's of course of great concern for the Federal Reserve. And I think that probably what's going to happen is that we're going to see assets drop quite substantially this year. We're going to regress basically back from the last 2 years' advances that we've seen. They won't go back below the pandemic lows, but they'll have a good retracement of those gains. And then after that's finished, we'll go back up again. And that's when the dollar focus is coming into mind, because I think then the dollar should be already quite a bit lower. We'll start to accelerate down. And I think that's going to give perhaps these commodities another shunt to the upside to new record highs.
Mm-hmm. So as we think about, let's say, the contributing costs to the CPI, Peter, are you forecasting that the CPI is actually going to accelerate yet again when we see the commodities resume their progress to the upside as well?
Well, I think that's right. I think there's going to be a regression phase in CPI. And after that, I think that we're going to then see a bit of correction. Let's have a look at, let me see if I can find the CPI here. Now, this is this is the longest time frame I've got for CPI. It goes back to 1900. And you can see that this is the pandemic low, which I'm pointing to right now, and this is the CPI running up. We're in this broad corrective phase. And if we look at this under the microscope a little bit, go a bit closer up, we can see that here again is the pandemic low, and we're moving up like this. Now, I'm going to go into even into the smaller time frame and look at that advance here, which is this chart. And you can see the basic Elliott structure again, even in the CPI, which is only one data point a month. Mm-hmm. You know, we're seeing very little data here, but you can see the basic structure of 5 price swings. And we're coming into that close now at 750. So I don't think that we're likely to go much higher than 750. If the next month we come out with a slightly higher headline number, I'd be surprised. It might go up another 0.2%, but I doubt it. I wouldn't be surprised actually if we're already starting to cool off. But you see, this is why I'm thinking that this year we're going to see also a regression phase. Mm-hmm. And we need to come back to the 4th area of preceding degree. This is about a 38% adjustment before we go up. But in answer to your question, Tom, I think once that regression phase is finished later this year, maybe early next, we'll then go up even higher. And I think that this will be when we start seeing the commodities kick on to the upside, make new record highs, and we'll get the CPI going up into these, you know, close to double digits, something like that. And that will be then, by that time, the dollar should be a lot weaker than it is today.
Mm-hmm. So when we're looking at that next high, Peter, do the charts have any predictive value for that time frame, or is it just simply that new high?
You're talking about the time frame for that particular model?
Does it predict the time frame of that next high?
Well, not the Elliott model doesn't. No. Okay. If we're going to get some concept of timing, we have to use cycle theory. So I've generally applied cycles over very, very different methodologies. I'm a member of the Foundation for the Study of Cycles, and in traditional terms, we're taught to do cycle theory in a very mundane way, and that is basically looking at a generic cycle from trough to trough, mm-hmm. and measuring that over time and seeing what the frequency is like. For example, let's have a look at maybe something for the dollar on a cycle. I'm just going to pull up something that I'm currently working on for our one of our currency reports. And this is a very long-term take of the dollar over a very long time frame. Let's have a look here. Here we go. Now this is this chart is the dollar index going back to the 1960s. And it's using what we call a 15.6-year cycle. And when we use cycle theory, a 15.6-year interval is basically from trough to trough here. Mm-hmm. If there's a median point, in other words, the median point here is centrally translated. In other words, if we divide 15.6, and we get 7.8 years intervening in the top cycles, we can put them here measuring equally as well. This is just basically one cycle. The red line is just one cycle overlaid to the dollar index. And what this tells us is that, you know, at the very least, there's going to be a low in 2023-24. Now, I've subsequently, I've used the tops in order to measure that cycle, but what I should be doing is actually measuring the lows. And if I measure the lows and I apply a 16-year cycle instead of 15.6, the phase variance of the cycle moves across to the right slightly, and that projects the dollar actually forming that low that I showed earlier. It's about October 27, so it could extend that far. And this is a very basic concept of using one cycle time interval in order to project a potential turning point. So this is nothing to do with price now or the pattern development. This is just to do with time and the direction of it. Equally, we can take something like crude oil, and I can actually, on a smaller time frame, if I want to know some of the peaks and troughs of crude oil, let me just see if I can find something for crude oil. We've got what we call a composite cycle, which means that we've got several intervals all combining together to give us an idea of the efficiency of how they're translated. And this is basically a crude oil composite cycle overlaying the price pattern. It's nothing to do with the price levels. It's purely timing and the direction, where the peaks and troughs are coming from.
Right.
So we'd have to use cycle theory in order to evaluate timing. And we come back to the CPI, which is this chart. We can do a cycle theory on CPI. I haven't actually done that, but we know approximately, with the dollar being where it is, and we've got a 94-year cycle in the stock market, which terminates in 2024, early 25, something like this. From that point of view, we can say, right, well, we know that everything in terms of risk on, inflation, processes should be topping out somewhere around that time frame. So we can estimate some of the indices doing that. Sometimes they lag a little bit behind, but they shouldn't be lagging behind too much. So we can get an approximate idea of timing from these cycle charts. Yeah.
Interesting, other data point to be able to overlay on figuring out, approximate timing there. Peter, I'd like to go back to kind of what we were talking about, let's say with the highs with gold. How do you think that those new highs will affect the gold miners? Do you see a lot larger percentage increase in the gold miners, or, even let's say silver, as proportionally, we understand that they should move a lot further percentage wise than the price of gold itself?
Yeah, I'm actually a very big proponent for buying the gold miners, because I think that gold bullion per se will underperform the gold miners. We had a pretty interesting time actually on these for our clients, at least, going back to this low here, which I'm pointing to. This is Newmont Mining, by the way. I think it's a good archetype because if you look at the GDX gold miners ETF, the data we haven't got. That wasn't really. There's not really great historical data on that. It doesn't go back too far.
Right.
It's enough, but obviously we want to go back as far as we can. And Newmont Mining, out of all the gold miners, seems to have the longest term data. So we use this as a sort of an archetype frame reference point. But most of the gold miners shared one thing. The GDX data actually began, I think, somewhere around here, this time period, about 2005-06. So it included this high in February 06, which is, of course, pre-financial crisis. It was already starting to drop down, and you can see Newmont Mining going from $62 down to $21 in 3 price swings. And then we had a rally, which took out the high, and then a collapse. And these 3 price swings down, so that's down here, back up to make a modest higher high, and then a collapse lower, has a very definitive pattern recognition in terms of Elliott. We call this an expanding flat. It's a correction. And if the price was already trending up, that means once it's over, it will trend up again like this. And that's precisely what happened. So when we were getting our reports out at the beginning of 2015, 2016, we said, well, we've got a major event developing here. We've got these miners are going to be bottoming somewhere around this price level, and then they're going to usher in a new uptrend. And you can see here we've got targets at 166 to 187. And those targets actually haven't changed for the last 5 years since we forecast that move developing. So if you look at it in terms of price percentage increases, we've already seen big multiples, whereas you haven't seen that in gold bullion. And we've got targets still 166. Well, the multiples aren't as big as they were anymore, but they're still what? More than doubling. They're more than doubling to get up here. Well, gold won't double. Gold is basically 1900. We're not going to get up to 3800 or something like that. It's not going to be possible. Gold, I think at the maximum, the bullion price will get to 2800 maybe, but that's going to be about a push. So definitely, there's going to be outperformance in the gold miners. Yeah.
Which is interesting to think about, conceptually, if the dollar, let's say, goes down by 50% or 45%, I believe you were saying, for gold to only increase by, let's say $1,000 from here, $900 from here, that seems, a little bit counterintuitive, right?
Yeah, it does. I mean, the thing is, though, that what is going to trigger the dollar to go down that much? I think it will be higher interest rates. Mm-hmm. And higher interest rates are going to be a huge headwind for gold. So I think that gold is going to be held back by that. We've actually just last week seen a very significant high in 10-year Treasury yields and the 30-year bond yield as well. That also is replicated here in Europe as well in the bond yields. But so we're expecting for the next 6 to 8 months for yields to decline quite a bit, I have to say. But after that regression phase finishes, we're going to see a new uptrend develop. We're going to see more inflation pressures coming back again, returning after this year's pause. And I think that you're going to see, maybe you're going to get 10-year Treasury yields, which have just topped out at about 2.06% last week. They're now we're projecting well over 5% in the future. Well over 5%. That's the 10-year Treasury yield. Mm-hmm. And I think the yield will also invert the yield curve in the future. That means that the short end of the curve will be higher than the long end. Mm-hmm. I think that's certainly attainably possible. The only way that can occur is if we've got real problems in the financial system. Mm-hmm. And I think that will be the demise for the dollar that I'm thinking of, because I think the dollar will have to be devalued in order to combat the inflation. Right. And the sheer amount of money that's on debt. Mm-hmm. So I think gold will be held back by rising interest rates. Mm-hmm. What I like to and prefer, really, other than gold miners, which is better than bullion for sure, is actually silver, because I think silver as a commodity can make new record highs, even though it's been struggling of late. Let's see if we've got a silver chart here. Yeah. This is basically relatively long-term silver. I mean, it goes back to the 1990s when gold was at 250. But this pattern up, we're expecting silver to get to at least $65, maybe a bit even higher. Mm-hmm. So silver will, as a percentage terms, will outperform. We've got a great buy signal coming soon on silver for this year. And I think gold will also start to trend up later. Maybe not immediately today, because I think there's some overhead resistance at the moment, just above 1900 on gold. But this represents a really good opportunity later this year. I think we're going to see at least between $34 and $37 on silver later this year. So I think silver is going to be an outperformer. And if we take a look at the gold-silver ratio, let's have a look at that, you'll see why. Because ultimately, the very long term, let's see if I can find this quickly. The very long term gold-silver ratio is quite extraordinary. Let's hopefully not. Okay, here we go. This is gold-silver ratio going back to 1930s. And what we're expecting is this from this point here. This was when silver was only 18 ounces to 1 ounce of gold. Mm-hmm. So this is when silver was really outperforming back in the 1960s. Mm-hmm. And just recently, into the pandemic high, you had to find 112 ounces of silver to buy 1 ounce of gold because silver was so devalued. This was a fantastic place mm-hmm. to buy silver outright, because I think that this entire pattern up has finished a generic uptrend, and silver over the next several years, if not into the next decade, will be an outperformer of gold. So the ratio will basically contract. And I think that silver represents a great opportunity. So there's, as far as I can see, there's absolutely no reason to buy gold in the next big bull market. you've got a choice here. You either buy gold miners or you buy silver as well, if you really have to hold bullion. So I think gold's going to be an underperformer in relative terms. I don't see why that should be necessarily attractive to hold.
Right. So by extension, then, are you looking at any of the silver miners as well from there, Peter?
I think let's have a look at. I think there's one of the most topical ones that I seem to get is Silver Wheaton, isn't it? Let's have a look at that. Let me just see if I can find that. Yeah. Okay. This is Silver Wheaton versus silver bullion. Yeah, there's some disparities between the two. See if I've got some updates here. I thought I had. Let me just check something. Otherwise, we'll look at XAU, see if we have something on that. But generally speaking, the overall idea is that the silver will outperform. I think maybe it's Fresnillo. Okay, yeah. Let me just look at one other silver mine. Yeah, this is Fresnillo, which is one of the big silver mines as well. Not a lot of data on this, but huge upside potential. Well, this one's trading at $695. We've got a projection a little bit lower, but ultimately we're talking about 7,400. So what are we talking about there? I mean, multiples of basically, sort of 10 times, aren't we?
Yeah, it's really interesting to try and think about how the miners really, run multiples of the underlying base metals, right?
Yes, I mean, there's an ETF on silver bullion, which is very highly leveraged. So if anybody listening in, if you're not used to trading leverage on some of these things, on especially if they're margin called, you've got to be very careful. I mean, the nice thing about something like Fresnillo is that you can buy it and put it down, and if the trend is correct, you don't get stopped out because you're not leveraged. But there are leverage vehicles on ETFs, and one ETF which I was looking at for one of my clients the other week was on this symbol, which is AGQ. AGQ, and the potential here is enormous. I mean, here this ETF is trading at 36.10 today, but I think we could easily get minimum up to 138. So there's some huge upside potential coming here.
And is that 2 times leverage, 3 times leverage from that?
That one is 2 times leveraged. Yeah, okay. 2 times. Yeah, that's 2 times leverage. Yeah, I think that's enough. Yeah. But so there's some really interesting stuff around, and Fresnillo is one stock. But I mean, the nice thing about an equity is that once you've paid up, you can just sit on it. If it goes against you a little bit for a while, okay, it's not too, it's not going to keep you awake at night. So let's put it that way.
Peter, before we wrap up, do you think we could go through the uranium chart just to see where you think things are heading for the, some of the energy metals, let's say?
Right. Well, that's interesting. Yeah. Let me just have a quick look at uranium. Okay. Well, the long-term picture is quite interesting. This is as long-term as we've got. Don't forget, uranium is not a metal that was discovered in the Middle Ages. It was only relatively in recent history that we discovered the qualities of uranium, at least, and still plotting it as a commercial commodity for nuclear power. But so we go back to about 1988 on here. Here's basically the final stage of what we interpret to be its secular bull uptrend. And since then, from 136, we dropped down to $18 a pound. So, I mean, that's a decimated decline. And we tend to think that that the upswing here will not start a new supercycle trend or anything like that. It's going to be basically a correction to this preceding decline. But, it can get up to $75, maybe a little bit higher, but that's the way it looks in the future. There is some ETFs that you can trade on this, or some actually good equities, and there's a few that we've been tracking because basically our clients have asked for it. The codes, if anybody's familiar with uranium, these are the two largest ETFs. I think URA and URNM, and we actually seen this decline into the pandemic low. This is URA, this one. And we've got a very distinct 5-wave structure. Look, coming in like this. So we've got this archetype 5-wave structure that we began looking at today on the very, very long term from the Great Depression lows. And that's very evident here in the last year and a half. We're coming through a regression point at the moment. So the minimum price level target is about here. We'll take a look in the next weeks to see if this pattern is finishing here. But if it does, we can expect that to come through. Going from 17 to 53 is quite a nice trade to have. And this is URA, and URNM is doing something similar. You can see in this particular chart, here's the 5-wave construct. This is going back again to the pandemic low. And we've got this further downswing to develop here. So we're coming in, it looks like our downside targets have been met for wave A of this zigzag corrective phase. We need a bit more of a dig back to the upside probably, and then we'll get down to maybe $40 later this year. And then uranium can start moving up. It's a fascinating commodity. Yeah, absolutely. What interests you about that, Tom?
About uranium?
Uranium, yeah.
Well, we like to cover it on the show. Personally, I think that nuclear energy holds a lot of promise for the future. But, I always like to try and get different perspectives, whether it's, an extremely bullish case or bearish case, and how, different people, view the chart developing. I think that's important to try and piece together something that, we might be missing on one side or the other.
Yeah. No, absolutely. No, I mean, uranium has become, quite a popular one to really sort of to look at. And we've been looking at the underlying spot price, obviously, for quite some time. This one's got a slightly different rhythm, but these are more tradable than the underlying spot price. Of course, it's difficult for anybody to go out and buy uranium on a spot price basis. So these are the natural ones to look at. This is North Shore Global Uranium Mining. And I think it presents a very nice investment opportunity because, at the moment, nuclear power is being considered. Obviously, the perception about coal is another one because, in the Western countries, coal is supposedly being phased out. But of course, in Asia, if you talk to any traders out there, and we do, you'll know that coal is huge. And although Beijing in China has been pulling back on its carbon footprint to some extent, it's still buying huge amounts of coal. That's not going away yet. Not yet, at least, anyway.
Absolutely. Yeah, it seems, the transition to the green future, we're still quite a ways from that, right?
Yeah, I mean, we're making good grounds, but is it going to be fast enough and quick enough? That's another debate, isn't it? Really, but it's great that we've got other alternatives for energy power. I mean, you can trade the carbon futures in Europe, the carbon allocations. You can trade that as a contract. We have looked at that in the past to see what that's doing. But as far as green energy, of course, things like some of the power companies, and just this whole aspect of natural gas prices jumping up in the last 12 months has been very much part of that CPI component you were referring to earlier, because that's been a big component of rising inflation pressures. I mean, natural gas has eased off since then, which is good. Since rallied back up again, but there's certainly alternative energy sources coming through, and we need to really make a much faster adjustment to those, I think.
Absolutely. And, Peter, it's interesting how you were talking about, not being able to buy spot uranium. Have you heard of the Sprot's spot ETF fund that gives you price exposure to physical uranium?
Okay, well, that's fun. I haven't seen that. I mean, send me the details. It'd be fun. Have they started that contract relatively recently, or is that something that's...
Absolutely. It's only a couple months old. They're still waiting for a listing on the New York Stock Exchange, which they're hoping to, let's say, finalize sometime this year. It's kind of funny because Sprott has an ETF for silver, gold, and now uranium, but obviously you can't take physical delivery of the uranium. But they're basically taking pounds out of the spot market by an at the market offering, which is a really interesting concept.
Yeah, it's a bit like the old time before ETFs were born. We used to have what's called warrants, and you'd used to, if you wanted to issue a warrant, you'd buy up the underlying commodity, and you might say, well, I'm buying like 100,000 tons of copper, and then you issue a copper warrant, and then you can buy and sell it freely around that physical entity. So it sounds a bit like the same thing, but if it's only been active for a couple of months, there's probably not much price data to work from our perspective. But depends on what they sometimes might do, and I don't know whether this is the case. I'll have a look. Is they might benchmark it. So they might say, well, benchmark it against the underlying spot uranium price, and then we'll create some data. We'll just say that day one trading is 100. And everything from previously will be, historical price data will go back maybe 10 years or something. So hopefully they've done that. That would be a good idea. Then we can actually plot some price movements on that. Yeah.
Right. Peter, I want to thank you for a really interesting conversation and being so liberal with your charts and your information here today. Is there anything you'd like to add before we wrap up here?
Well, just to say that it's been, well, of course it's been enjoyable. You and I have never done something like this before, so it's really great to meet you and go through everything. And I would just say that when anybody is listening in and they want to trade, one of the first and most important things is self-responsibility. That's not a catchphrase; it's a truism, really, when trading, because we each have our own way of doing things. We can't, and we should accept responsibility for each other, but primarily for ourselves when it comes to trading. So just bear that in mind. Some of the charts that you've seen today that I've shown, I'm really basically giving a risk disclosure because, obviously there's sensitive data that I've shown here today, but you must take self-responsibility, as everybody should do for themselves. So just be aware of that and be sensible. Don't overstretch. Make sure that you always sleep at night. That's the most important thing.
Absolutely. There's a lot of psychology, as you and I spoke about before we hit record, about, there's so much to learn about getting your emotions and everything wrapped up into a trade. And it's far better to be able to be more, as you said, stoic, to be able to analyze that trade for what it is and take the emotions out of it.
Yeah, I think so. I mean, I think that's got to be the ultimate goal for everybody. The holy grail of trading is really not to get caught up in that. Don't forget the whole idea of automated trading systems, which have come through on the quant level these days, is basically born out of the fact that it's tough to make investment decisions on an individual basis. And so a lot of people can't emotionally absorb that process. So what they do is they create quant systems because they can't humanly absorb that and take responsibility for it. So it takes a lot of guts and courage. Anybody out there, I salute you, because anybody that's trading real money in the markets on their own, in particular, or in small groups, I'm a big admirer of you out there, whoever you are. I am. And it's that's something to be honored. Yeah.
Absolutely. Peter, of course, your website is available at wavetrack.com. You also have a Twitter handle, do you not?
It's at Elliott Wave _ WTI. So at Elliott Wave _ WTI. WTI is WaveTrack International. Yeah.
Perfect. Of course, we'll link to that in the show notes as well. Peter, I want to thank you so much for your time today. It's been excellent.
Thanks to you too, also, Tom. All the best to you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.